Right now, shares of Rezolve AI PLC, trading on the NASDAQ under the ticker RZLV, are sitting at $4.46. That's up just a penny, about 1 cent or 0.22% in the first hour of trading. And right away you might see that tiny green number and think this is a quiet, consolidating stock. That is the expectation. The reality, however, is that this $4.46 price point is not a sign of calm. It's the dead center of a hurricane. This stock is an absolute battleground. And that flat line you see is hiding extreme turbulence under the surface, defined by massive volatility, a recent management overhaul, a string of shareholder lawsuits, and some of the most aggressive forward-looking guidance you will ever hear from a company this size. What we are seeing with RZLV is a profound disconnection between the story management is telling and the numbers the company is actually printing. Most investors hear about a company like Rezolve AI, and they immediately lump it in with the dozens of other small-cap artificial intelligence plays that have come to market. The narrative is familiar. A small speculative company with some interesting tech may be a good candidate for a small position in a Robinhood or SoFi Invest account, hoping to catch the next big wave. People see AI in the name, they look at the 52-week range, which stretches from a terrifying $7 to a tantalizing $8.45, and they think it's a lottery ticket. They believe the path to upside is just about the tech being good enough. But that is not what is driving this stock. This isn't a simple bet on a new technology. This is a high-stakes wager on management's credibility. The deeper take here is that RZLV's future isn't tied to its algorithms as much as it is to its balance sheet and its ability to survive a storm of legal and operational pressures. This isn't a stock you just set and forget in one of those Schwab intelligent portfolios. This is a name that requires active, daily monitoring. Let's break down the recent action because that's where the real story is. Today's trading, just 55 minutes in, has seen the stock open at $4.46, pop to $4.50, and dip to $4.36. The volume is already at 1.75 million shares. To put that in perspective, the average volume for the stock is around 19 million shares, so to see nearly 10% of its entire average day's volume trade in the first hour tells you the interest is high and the hands trading it are active. This is not a passive investment. This is a trader's paradise, or perhaps a trader's nightmare. The reason for this frantic activity is the news flow. Just yesterday, the Pomerantz law firm announced it was investigating claims on behalf of investors, alleging securities fraud. This isn't the first law firm to do so. Several have piled on, creating a cloud of legal uncertainty. This is a massive red flag. When lawyers start circling, it implies that there might be a significant disconnect between what the company has been telling the public and the financial reality. Now, juxtapose that legal pressure with the press releases coming from the company itself. On October 27th, Rezolve announced it would be participating in upcoming investor conferences hosted by RBC Capital Markets and Roth Capital Partners. This is a classic management move. When your narrative is under attack, you go on offense. You get in front of the big institutional players to tell your story directly. This very next day, after announcing the new CFO and COO, management did something incredibly bold. On October 23rd, they reaffirmed their 2025 annual recurring revenue guidance of at least $150 million and, for the first time, initiated 2026 guidance projecting a $500 million ARR exit rate. Let that sink in. A company with a market cap of around $1.4 billion is promising to be on a $500 million revenue run rate within about 2 years. This is the kind of guidance that makes or breaks a stock. If they are right, $4.46 is an absurdly low price. If they are wrong, or even just exaggerating, the fallout could be catastrophic. This is the central tension. This is why the volume is so high. The market is trying to figure out if this is visionary forecasting or desperate promotion. Famed market commentator Jim Cramer recently said this was one of the most promotional companies I have ever seen. That kind of comment sticks. This entire drama is amplified by the company's recent financials. The core of the expectation versus reality problem lies right here. For the second quarter of 2025, Rezolve reported revenue of just $3.16 million. That was a 54.88% miss against analyst estimates. The company also posted a net loss of nearly $29 million. How investors are asking, does a company pulling in $3 million a quarter get to a $150 million annual run rate, let alone $500 million? This is the question that defines RZLV. The bull case is that their new agentic commerce platform is at an inflection point. The bear case is that the math simply doesn't add up. This isn't like analyzing Apple stock where you're forecasting iPhone sales. This is trying to decipher whether a company's grand promises are built on a solid foundation or on thin air. This is the kind of speculative online investing that can create fortunes or wipe out an individual brokerage account with equal speed. So what does Rezolve AI actually do? The company provides generative AI solutions for the e-commerce and retail sectors. Their flagship platform is called Brain Suite, which is powered by their own large language model, the BrainPowa LLM. The entire idea is to create what they call autonomous AI agents that can manage customer engagement and commerce. Think of an AI that doesn't just answer a question, but actively guides a consumer through a purchase, suggests products, and completes transactions. They've boasted major enterprise customers, including names like H&M, ASOS, and Ferrero. This is the story that got the stock so much attention. The potential to embed their technology into massive global retail operations is undeniably huge. If they can capture even a tiny fraction of the transactions from those clients, the revenue numbers could, in theory, explode. The problem is the if. We've seen this story before with tech companies that land huge design wins or partnerships that ultimately translate into very little revenue. The market is skeptical. It's been burned before. The company's past performance is a testament to this volatility. Rezolve AI came to the public market, like many speculative tech names in recent years, via a SPAC deal. These vehicles are often used to bring companies to market faster, but they can also bypass some of the traditional scrutiny of an IPO. Since its debut, the stock has been on a wild ride. The 52-week range of $1.07 to $8.45 tells you everything you need to know. This is not a stock for someone who needs investment help or wants a stable long-term compounder. This is a stock for traders who use platforms like Interactive Brokers to get in and out with precision, or for deep value speculators who believe the market has completely mispriced the company's future. The company is also burning cash at an alarming rate. Its cash from operations in the trailing 12 months was a negative $36.55 million. With only about $9.8 million in total cash on the balance sheet as of the last report, the clock is ticking. This cash burn is the single biggest risk. If they can't ramp up revenue to offset this burn, they will be forced to raise capital, likely through selling more shares, which could dilute current shareholders and could send the stock price spiraling down. This brings us to the future outlook, which is truly a binary path. There are two very distinct possibilities for Rezolve AI. The bull case, the one management is selling hard at the RBC and Roth conferences, is that they are right. In this scenario, the new COO and CFO, Arthur Yao, who was just appointed, is a seasoned operator who will fix the execution problems. The recent shareholder transfer to a new global institutional investor that the company announced on October 23rd was a strategic move to place a large block of shares in stable, long-term hands, taking it away from short-term traders. In this world, the AI tech is real, the H&M contracts begin to scale massively in the coming quarters, and the company hits its $150 million ARR guidance. If that happens, $4.46 will not be at $4.46 for long. The short sellers will be forced to cover, and we could see a squeeze that rivals the volatility of Tesla stock in its early days. Analysts from firms like H.C. Wainwright and Cantor Fitzgerald have buy ratings on the stock with price targets as high as $10.58. They are buying into this hyper-growth story. Then there is the bear case, which is grounded in the harsh reality of the current numbers. In this scenario, the 150 million and especially the 500 million guidance is nothing more than promotional hype designed to keep the stock price elevated while the company burns through its remaining cash. The class action lawsuits gain traction, revealing internal documents or whistleblower testimony that confirm the company misled investors. The revenue miss last quarter wasn't a blip, it was a trend. The big-name clients like H&M are only running small-scale pilots that will never translate into meaningful revenue. The cash burn continues, forcing a highly dilutive secondary offering by early next year, which crushes the stock price back down toward its $1.07 low. In this reality, the Fidelity and SoFi investors who held on, believing the hype, are left holding the bag. The company becomes another footnote in the post-SPAC boom and bust cycle. So how do you trade this? This is where platforms and strategy matter. A sophisticated trader using interactive brokers might be playing the volatility, buying the dips and selling the rips, setting